a real pleasure to be in conversation today with Varun Khanna from KKR. Varun is a partner in the firm's private credit business and co-head of KKR's global asset-based finance strategy. He oversees the investment team as well as the firm's asset-based finance funds and accounts, and sits on KKR's global asset-based finance investment committee and the European Real Estate Investment Committee. He joined KKR in 2016 as one of the first members of the asset-based finance team. Before that, he spent over a decade at Deutsche Bank, where he was a managing director in structured finance and began his career in equity research, covering technology companies. He holds degrees in economics from the University of Cambridge and St. Stephen College in Delhi. Varun, thank you so much for taking the time to speak with us today. How are you?
Good, thanks, Aryan. This is definitely not a usual Friday conversation for me, but looking forward to it.
Glad to hear that. So we'll just kick things off. We'll keep it very simple. For those who may not be familiar with what asset-based finance is, how would you exactly define it, and how does it sort of differ from more traditional or, I guess, conventional lending strategies?
Sure. I would say simplistically, the form of credit that most people are familiar with, whether they are starting their careers in finance or trying to learn about, the world of banking and alternatives and PE and private credit, is essentially what I would describe as lending to companies or lending to corporates, right? And even that in itself has different versions and flavors. So if you think about it, there is lending to corporates that happens from banks on their balance sheets. Historically, that used to be a big provider as a sector, the banking sector, of credit to companies. Over time, that got supplemented by credit provision to corporates by the public markets. So you have an active leveraged loan market. Then over time, you added a high yield bond market or an investment grade bond market. So you have public loan markets, public bond markets, and then private bank lending that lends to companies or corporates. And if you take all of that together, that's the bit of credit, whether it's private or public, that most people tend to be more familiar with.
Mhm.
What we describe as asset-based finance or ABF, simplistically, is credit provision to the rest of the real economy, right? So you get a student loan, eventually you get a mortgage, you get a credit card, and then you aggregate all of that. It's not just Aryan, but like 500,000 Aryans, right? With individual mortgage loans or individual loans to take to finance the purchase of a car or to pay for tuition fees. That pooled credit provision to individuals, to small businesses, to finance the real economy away from single name corporate credit is what we describe as asset-based finance.
Okay.
So that's one way to think about it. So I've given you a few examples already. This covers all forms of consumer credit. I gave you a few examples of that. It covers other forms of credit provisions, such as leasing, so receivables financing. So so you could have a portfolio of trade receivables, right? So think about the supply chain in the corporate universe, right? Apple buys products from a supplier, but they may have hundreds of suppliers, right? Those short-term receivables that are owed from Apple to those suppliers can all be pooled or aggregated together in a portfolio that gets financed, right? So that's ABF. So the other distinction, so far in all that I've said, there's 2 points I'd highlight. One, this credit provision is touching the rest of the real economy away from single name corporates.
Mm-hmm.
And then the second point is it's not a single name credit strategy. And what I mean by that is my point around, in typical corporate credit, you are lending to a company, right?
Sure.
Here, when we are making an investment, we're investing in a portfolio of loans that could include hundreds of thousands of underlying loans to individuals or small businesses. So that portfolio-based nature is the other distinction versus the traditional forms of credit.
Okay, that's really interesting. In a more personal line, what sort of drew you personally as Varun into ABF? And what was your journey like as you sort of entered KKR and helped build a team from the ground up?
Yeah, look, I think like most things in people's careers and lives, there's a little bit of chance and accident. I started my career after university here doing equity research, which was essentially following single stocks. And the sector I was particularly focused on in the early 2000s was what was specifically described as telecom equipment. So think about Nokia, Ericsson, Alcatel, those kind of companies. So this was the world of handset manufacturers and wireless and wired telecom infrastructure manufacturers pre the world of Apple, right? Where Nokia was the biggest player in that segment at that time. Now you don't even think about it. You probably have never owned a Nokia handset. So it was a very different universe. And so, yeah, I started. So actually, a lot of what I started with my basic training was on single name corporate analysis, right? From a public equity lens. But that's where I started. And then at some point in time in the mid 2000s, I made a switch to the credit side of the bank. And I ended up in what was called a structured credit business, which essentially is what I do today, asset-based finance, right? It was called something different. Spent many years at a bank, eventually moved across, like a lot of people in my generation, made the shift from doing exactly this at a bank post the financial crisis in 2008 to 2010. There was a shift in how banks got regulated, and it impacted bank behavior in this business, i.e., it impacted banks' ability to do the same business in the same way that they used to do, limiting the amount of risk they could take. As that created a gap, private capital stepped in to fill that gap, and eventually it opened up an opportunity for me to land up at KKR to do something essentially similar. So that's the very, very quick version of it. And a lot of this is, chance.
Yeah, pure luck and chance. That's well put. Were there any mentors or any early figures you had, both during Deutsche and also during the transition to KKR, and even now, perhaps?
Always, I think, and again, this may sound very cliched, but a lot of the decisions you make and the moves you make, whether they're within an organization or from organization to organization, are typically driven by, a combination of what you find interesting and what you're good at, but also who you're surrounded by, right? And typically, and so yes, I could go on and on thinking about people I work with that were really good and inspirational that led me to do, X, Y, Z, but also people who weren't, right? So typically, when you make changes, they tend to be influenced by, people who inspire you. Yeah, so absolutely.
Yeah, that's really nice. Bringing it back to KKR again. So this is how I view. I know a lot of people would agree, maybe some would disagree, but KKR is always, often associated with private equity. It's a very sexy business, very appealing. Everyone wants to enter it. Could you sort of unpack some of the micro and macro drivers that sort of have taken the shift towards private credit, particularly within KKR?
Sure. I think one of the lesser known statistics in the outside universe is credit is actually the biggest sector or asset class within the KKR ecosystem. That surprises a lot of people, right? Now, that wasn't the case 10 years ago when I started here. And that speaks to the point you were making. I think there's multiple drivers, as a lot of the alternatives firms, including KKR, started off in private equity, right? That was a great sector and asset class for them to grow into. And that remains a meaningful part and a big part of what we do as a firm. Inevitably, like most companies, you search for other areas of growth to diversify away from your core area, right? And you cannot have infinite growth in a business that you started in almost 50 years ago, which was a KKR story. You could have 10, 20, 30, 40 years of growth. But at some point in time, it's going to take you to a point where that's a great core business of ours. And then we start looking at, all right, what else could be synergistic with what we already have? And that's what led us as an organization to adjacent asset classes like real estate, like infrastructure, like credit, right? And credit in all its flavors, from public credit to private credit, from corporate credit to asset-based finance. And so that's one aspect of it. I think the other aspect of it is it coincided, this desire to diversify and seek other areas of growth coincided with a period where there was a big shift in bank regulation, as I was mentioning earlier. So it provided an opportunity for people like KKR and others that look like us to potentially look at an ever increasing gap that was being created in, say, for example, credit provision, because banks couldn't do everything in exactly the same way as they used to do in the credit universe pre and post 2008, right? So when that gap gets created, someone looks at it and goes, could I fill that gap? And so that's part of the other half of the story.
Okay, no, that makes a lot of sense as well. It's all very context and time dependent. Um,
Absolutely. Absolutely. And
Perhaps.
look, typically these kind of firms will not make big decisions to enter or exit a space with a short-term time frame in mind,
Yeah.
right? So a lot of this will take years of thinking about, all right, is this a trend or a transient theme, right? And if it's the former, you build more conviction to strategically lean into that space.
Yeah, that's true. I agree with that. What does the process sort of look like for you and your team when you're sort of valuing an asset or opportunity? And I say asset as well because I know you can obviously look at cash flows and all these things, but also like an emotional value to something that something you can see with your eyes if it's a physical asset, tangible.
Yeah, it's an interesting question. I would say if we take a step back and think about the two types of credit, the way we defined it at the start of the conversation, lending to companies and lending against portfolios of assets. I think in both segments, I would argue the common piece of analysis is forecasting a set of cash flows that a company can generate or a portfolio of assets can generate, right? So that's the commonality. You have to get a view, a scientific view, with a subjective overlay, which I'll come back to in a second, on how is this company or how are these portfolio of student loans going to cash flow over a period of 5, 10, 15, 20 years, right? Whatever the time frame may be. So that's the common thing. Now, we all have our biases. So I would say from my seat, I think forecasting a set of cash flows that a company generates involves a healthy mix of science and art, right? And the science and subjectivity, I should say. So the scientific bit is analyzing the company's financials, its balance sheet, its cash flow statement, its P&L, and understanding what drives each of those line items, and then coming up with a certain set of key assumptions, whether they are volume driven, price driven, cost driven, to forecast the future performance of those cash flows. You then add a subjective overlay, which is where the art bit comes when you look at a company. Is this a good management team? What kind of sector is this in? Could there be a disruptive force, either technology driven or it could be AI, it could be something else that could change some of these assumptions and the cash flow trajectory of this company. Are the barriers to entry high or low, right, in this sector? Is this too reliant on one supplier or one customer? So that's where an element of judgment comes in. I then contrast that to, my other example, there's an ABF or an asset-based finance example. I'm analyzing a portfolio of mortgage loans, right? It's in my view, a lot more data-driven when I'm forecasting the future cash flows, right? I know loan level information on what's the monthly principal and interest that Aryan owes on his mortgage, but everyone else in that portfolio also owes, right? So then I used to forecast the portfolio level cash flows every month. I then make an assumption on how many of those borrowers could default, right? If they default and I recover some money, that recovery value will be driven by the value of the homes versus the value of the loan. So there's a house price forecast built into the recovery, right? The loss rates will be driven a little bit by a view on the credit risk profile. Is everyone who's taking a mortgage like Aryan who's just finishing university, or are they all people with an average employment tenure of 10 years, right? So that different risk profile. Where are we in the macro cycle? So those kind of things. So again, if you see here in what I've described, it's very data driven, but then there's a subjective overlay because the subjectivity in the asset-based finance example may come in from, I could come up with the an assumption on loss rates and an assumption on recovery rates just by looking at historical behavior, but that would be a bit simplistic. If I don't overlay on that historical assumptions my view of where the economy is headed, or my view of where the consumer behavior is headed, or my view of where house prices are likely to go, then I'm not getting the complete picture on the cash flow forecast. So in both these examples, there's some science and some subjectivity. But it's all about forecasting cash flows, as you started off with.
Okay, that's really interesting. And for asset which you can physically see, say it's an iconic building. Do you ever feel like there's a, because you mentioned biases, but do you ever feel like there's an emotional aspect that I might be getting in this deal, we might be sort of getting into this because we've seen that it has iconic, impact, or people like it, or we like it, or
Yeah, I mean, look, it's human nature.
human nature.
It's human nature. In what we do in my immediate team tends to be less about making a bet on an individual asset. It
Mhm.
tends to be a diversified portfolio view on hundreds, if not hundreds of thousands of underlying assets. But you're right, right? Something that you can touch and feel, that you can see, that you're familiar with, you tend to naturally gravitate towards with more comfort. But it all comes back to looking at the numbers and the data and then trying to drive your final credit view based on that.
Yeah, no, I love how you position it as a science and art. I haven't really thought of it at like of the process like that, but it's really.
Sure.
Have you ever had a memorable deal? Anything that really stuck with you and you look back with a smile and you really enjoyed it?
You I could go on and on. We've, we did as a team, we we spent a lot of time over a year on a deal a couple of years ago with PayPal in Europe.
Mhm.
That was quite memorable. That was basically, you know, as I said, over a year in the making. It was complex. It's a business that we were all familiar with, but the solution we were looking to provide to them was quite a unique one, where they started doing some consumer lending in addition to their core payments business. That started up eating and consuming a lot of capital at PayPal across 5 countries in Europe. We work with them to take all those assets over a period of 3 years off their balance sheet, funding in the end, tens of billions of euros worth of loans, and not just on a one-off basis. It was a living, breathing deal where we're still buying loans from them every month as part of that project. So that was an exciting one in the recent past. But yeah, I could go on and on.
Yeah, that's really interesting. I think I read about that deal. I think it was a while back. What
Yeah,
would
2023, I think, from
yeah.
memory.
What is the risk landscape sort of like in asset-based finance as an asset class? What would you sort of define that as, and how do you sort of as a team go about navigating that? Because you sort of mentioned the science and art process, you can put that overlay, but despite that, there are always going to be risk factors to sort of account. And what are those risk factors mainly?
So we do quite a lot of things in asset-based finance, all the way from consumer credit to aircraft leasing to music royalty. So the risk factors tend to differ, obviously, from sector to sector. Um, I think if I had to generalize, it tends to be on, the usual combination of who are your obligors or your counterparties, right? So in my consumer finance example, it could be a bunch of individuals, or it will be a bunch of individuals. And what's the risk profile of those individuals and the payment behavior of those individuals? So that's one big factor that you have to get right. In my aircraft leasing example, it's a bunch of airlines, right? So you have to get your assessment of borrower or obligor payment behavior correct. So that's one big risk factor. The other big risk factor, to really simplify this, is you have to get your assessment of the value of the underlying asset, because this is an asset-based strategy, to state the obvious. Right. Right. So if I'm analyzing a portfolio of mortgage loans and I really did a good job of figuring out how the segmentation of the different risk profiles of the individual borrowers look like, how they performed at different points in the cycle, and how they're likely to perform in the next 5, 10 years. But didn't do as good a job of analyzing the value of the underlying homes and the apartments that backed that portfolio of mortgages, that's a big risk, right? Because if I thought the value of the underlying loans were worth 100, but it turned out that there was more like 70, if there were some losses, my recoveries would be lower, right? Equally, in my aircraft leasing example, I could get my airline credit risk assessment right, i.e., this is likely to be the payment behavior, but I got the what we call in aircraft leasing residual value assessment wrong, i.e., the forecast value of the plane at the end of the lease in 10 years' time. If I got that wrong, then that impacts my investment decision or my investment outcomes. So if I really had to simplify it, it's those two things. Getting your asset valuations right, not just at a point in time, but over a period of time, because these investments tend to be 5, 7, 10, 15 years long, and then getting your obligor or your borrower assessment right.
Okay, so it's a lot of due diligence involved in the process, and it's not just in long term as well.
Yeah.
That's a good way to protect against the risk. And what would you say sort of separates a good deal? So a deal that sort of offers a returns you're looking for and has a proper process and everything you want, but from a very like amazing, almost a great deal, what sort of is a distinction? Like, because obviously the space is getting very competitive, I think, set to grow a lot. How would you sort of distinguish a good deal from a great deal, to put it simply?
Yeah, look, I think there's many ways I can answer it, but maybe if I had to pick one, a good deal, this is a collateral-based or asset-based strategy. A good deal is one where, let's say I'm trying to make a 10% return over the lifetime of this deal in my base case, right? A good deal is one where if I had a severe shock like COVID or the great financial crisis of 2008, my some or all of my 10% return is at risk, but my principal, i.e., say if I invested $100 and I was supposed to earn 10% returns on it, but my $100 are not at risk, even in the recessionary scenario, that is one way to think about, in our world, what differentiates a good versus a bad deal. I.e., if everything goes to plan, I'll make around 10% returns. If I had a really severe recession, right? And the definition of a severe recession could be different for a student loan portfolio versus an aircraft leasing portfolio, right? But in the relevant severe recession case, my return's at risk, but not my principal. That's one simplistic way of answering your question.
So it's just maintaining the principle and sort of foregoing that interest.
Not in a, but if my interest is at risk with a slight bump in the economy, then that's not okay.
Only in the case of a crash or a shock that makes sense.
Yeah.
How does your approach sort of vary geographically? I know that different regions, different cultures, different ways of sort of operating in different places will have an impact, or at least I'm assuming it'll have an impact on the work you do. So how does that sort of play in, and which regions do you think are set to sort of be the future of asset-based finance or have significant growth in them?
Yeah, I would say a couple of things. One, you have to do these businesses locally, and what I mean by that is you have to have people on the ground who have familiarity with the markets, the legal frameworks, the historical context. Like a mortgage product works very differently in the UK to the US, right? Understanding the ins and outs of the products and the market and who originates those mortgages, how those have performed through different points in the cycle are quite different. So to state the obvious, we have people on the ground in the US doing asset-based finance. We've got people on the ground in different places in Europe doing asset-based finance. We've got people on the ground in Australia, in Hong Kong. So you have to have local presence with local knowledge and context to do this well. I think to answer the other part of your question, the US is the biggest market, one of the big in this space, but a lot of the growth in asset-based finance is going to come in Europe and then over time in Asia Pacific. And one of the big reasons for that is, go back to what I was saying at the beginning of this conversation around what created this private asset-based finance market. It was that big shift in bank regulation that started in the US. It then moved to the UK, continental Europe is now playing catch up. So as that timeline keeps progressing, more and more growth in this market comes outside the US. But here and now, 60-70% of what we do in asset-based finance is in the US. Over time, that may shift a little bit, right, in favor of Europe and Asia. But that's hopefully a bit of context on your question.
Okay, that's really interesting. Moving more so towards the people side of the business and people working within the business, what sort of makes someone effective in this form of investment, and how do you sort of how would you sort of advise that person to sort of enter the space and what skills they should develop?
Yeah, look, I think it's a little bit similar to most people in sort of finance, where you have to have a good combination of strong analytical skills, and you have to have the ability. You can learn those skills on the job, right? So long as you have the ability, and you have to balance that with good people skills, right? Just to be very generic, because at the end of the day, this may sound like a very analytically heavy business, right? It is, but we do deals with companies, with banks, with lending businesses, and people want to do deals with people they like, right? And they want to do deals with people who can come up with the right solution for the problem they're trying to solve. So the analytical piece needs to meet the personable piece. It may sound very cliched, but those two skills are very important. There are a lot of people I know who are incredibly smart, incredibly numerate and analytical, but may not be so personable, and they won't do as well, and vice versa.
Perfect blend.
So that's the attributes we're looking for in anyone new. And again, this is a lot of judgment, to be honest.
No, it makes sense though. It is a people's business. You have a lot of, Excel and all these analytical frameworks, but at the end of the day, they're just to help you. And it is, people at the end of the day that get the deals done.
Totally.
What have you learned about people through investing? That's including your time at Deutsche as well. What have you learned about people just as general? It's a very broad question.
I would say if you think about the people who you're working with, right? I think one attribute that is very important, and this is just one, is being able to trust that person's judgment at different points in time, right? And what I mean by that is, this can be a very up and down, and most actually, to be honest, most jobs are, right? But in the world that I've grown up in, i.e., finance, it can be up and down, right? Periods of high pressure, periods where things are not going well, periods things are going really well. You want to see balance in someone's judgment, right? Someone not getting too excited by something at one point in time and then getting too negative on the same thing at another point in time. So the more balance you can have in someone's demeanor and judgment, the more you will trust that person's analysis, right? Because let me, and what I mean by that, maybe with a little bit more context, is at the end of the day, say for example, in my universe, there's over 50 people in the asset-based finance team, right? Globally at KKR. I can't possibly know. And when we're looking at a deal, we spend months, weeks discussing them, right? We get people in my seat get to ask lots of questions, right? About the risks of a deal, about the specific features of a deal. But I can't know 100 things out of 100 on that deal, right? I can try and triangulate that with a series of questions, but an element of this is relying on the team who's working on the deal's judgment, right? And you're going to form a view on that individual or group of individuals over time as you see them react to different circumstances at different points in time, right? So a long way of saying the best people here, or in most jobs like this, are people who are good at the two attributes that we talked about in the previous question, but also are able to demonstrate credibly just balance and calmness in their judgment and demeanor at most points in time, right? Because that engenders confidence and trust. Uh, it again goes back to this is another way of making the point that this is a people business, right? Like equally, we are investing in our world money that is being given to us by typically pension funds, right? Now, they are giving us that money to invest in a large part driven by or a lot of work they do analyzing our capabilities, our historical track record. But there's also an element of trust and judgment, which comes from a personal interaction over a extended period of time. The same applies within our teams as well.
Okay, that makes a lot of sense. And it's very nice to sort of think about it from within the team, also considering the external stakeholders, because you're right. I think it's a people's business, and you're more likely to give your money to someone who I think is calm and not uh, acting like it's too good to be true, or is overexcited.
Yep. And
And
by the way, this is not specific to asset-based finance or private equity, or this holds true in most industries.
and it's a very human trait just to sort of trust someone who's very calm and collected. So I think it applies to life as it is. Um,
I think so.
yeah, is there anything you sort of looking back on your own journey? Is there anything you wish you'd understood earlier? So perhaps at your Deutsche days about investing, leadership, or sort of building a long-term career?
I actually don't think about it too much in that context because the reality is if you try to step back in any line of work and think about, oh, uh, you know, did I make X amount of mistakes? I think all of us we make mistakes every day, right? I think you could go in a headspin if you try to overanalyze all the mistakes you made, so long as you just remember them, right? And try and not repeat them to state the mega obvious. I think you're doing fine. But I'm pretty sure I make a mistake once a day, if not more often, right? Um, so it's just about constantly thinking about it because you're not gonna find the exact same circumstance again on a different deal or with a different person, but you're gonna find something similar. If you remember it, you'll probably learn from it.
And on that line, AI sort of has been synonymous with the idea of not being connected with this emotional bias or sort of having the things that sort of hold you back from making the right decisions. Where do you think AI sort of falls within this industry and how it could sort of help you and sort of act as a tool for people in private credit?
Yeah, look, I think we're in the very early innings of figuring out the power of some of those tools. Uh, but it is a big area of focus across the firm. Uh, in one sense, trying to make us more efficient in doing certain things early in the life cycle of an investment or a potential investment, right? Something that could take a graduate on the team 3 weeks of research could be with an AI tool sped up to 3 hours, right? Allowing that person to then still analyze the outcomes of that research and then do something more productive with his or her time. But like this is like the early days. I think it's going to change, exponentially in the coming months and years, the applicability of some of these AI tools. And some of them we're going to, right now, we're focused on 5 things, that are AI driven. I'm sure 3 of those things we're going to find are not that great, but we're going to find 10 others. So it is quite exciting, to just think about the possibilities, the efficiencies that some of these tools can bring to the table. But as I said, the main point for me is we need to stay curious and open-minded on this because there's going to be some great ideas and there are going to be some not so great ideas. And we're still in the very, very early innings of learning about the possibilities from AI.
Okay, that's really interesting. Looking forward to sort of seeing as the industry evolves as well. And hopefully when I enter the industry, whether it's any of these things or, people in my society or our uni, can sort of see these tools being implemented to sort of help make, corrections where we wouldn't as humans.
Yeah. Look, I think there could be that. It could be just making our lives more efficient, right? Certain tasks more efficient.
Okay. We have two final questions, so I'll keep it brief. What
Sure.
advice would you give students, just about finance in general, and then if you want to narrow in on ABF and private credit, just about entering the industry and sort of even general advice and just understanding what it sort of takes to get in.
Yeah, I think I give a common answer to both questions. Keep
Yeah.
an open mind. Don't overthink it, especially at this stage of your lives and careers. Because the one thing that surprises me and actually concerns me from time to time with actually there's a good and bad of your generation versus when I started, right? The good bit is the level of like this. I'm not sure this forum probably did not exist. Maybe it did, but like when I was finishing university, like a private equity society talking to someone about something as specific as ABF or asset-based finance, I can't imagine. So that's really good, right? That level of curiosity and trying to learn something in a bit more detail before you actually land up in the system is great, right? I think the flip side, which sometimes gives me cause of concern, is someone will come to me and say, "Oh, I'll meet someone in an intern lunch or somewhere, or at a graduate event," and they're like, "I really want to do healthcare growth investing, or I want to do, private corporate credit." And my reaction tends to be like, "You're 18 years old, right? Maybe that's what you want to do, but like, go into the system with a little bit more of an open mind, because most people don't really know, because you're not going to know what's right for you and what's the best fit until you're actually in there a little bit and you've tried a few things out. And the system is designed, especially if you think about traditionally the finance recruiting cycle historically has been driven a lot by you enter the banks, you go try a few different areas of the banks through your internship program and then your graduate program, and then you pick a lane, or a lane picks you, right? Or some combination thereof. There's some logic to that, right? So I would just like keeping an open mind, but I think is good and sometimes is underappreciated.
You think we have too much information?
I don't think you have too much. I think that too much information is good. A lot of information is good. I think the jumping to a conclusion on this is exactly what I'm going to be good at or what I want to do can sometimes be fine, because some people are genuinely logically arriving at that conclusion earlier than I may be expecting.
Yeah.
But I would bet that there's a lot of people who were just like, they heard one thing, it sounds cool, it sounds vaguely interesting, and that's it. That's what they're going to do. And by the way, the other reason to not do that is that may not be the best thing for you. You may be better at something else, but equally, people forget that all of these areas go through cycles.
Yeah.
Right? Infrastructure, real estate, private corporate credit, ABF, private equity could be hot as an area one day, may not be in 5 years' time. So that's another reason to not overthink this stuff. Obviously it's good to inform yourself as well as possible, meet as many people when you're in, before you enter the system, after you enter the system. You can always switch, right? So that'll be my main sort of piece of advice, I would say.
Great, thank you. And for our final question, so it's a bit of a different question, but what is sort of for you personally the greatest sense of fulfillment in your career, whether that's both professionally or personally, sort of within the career that you've sort of built?
Yeah, look, I think I don't think of this as like all right. I think I'm probably like, I don't know, 40, 50, 60% of the way through.
Mhm.
I think if you ask me this question in like 10, 15, 20 years time, I think the simplest metric is some combination of, surrounding myself with a really good group of people and building that over a period of time, which we've done to some extent in my world over the last 10 years, but we have to do a lot more of it in the next 10 years. And just doing what we were supposed to do. I find interesting investments to make. Uh, some of them unique, some of them not so unique, and then keep ourselves intellectually curious, do new innovative things where we can, but also not forget that you're supposed to, someone's giving us money to make a stated return on, deliver on that for them, right? Uh, if all of those things you can do well while surrounding yourselves with a nice bunch of people, I'd be happy, right? And then the last thing I would say is these are these industries are, and like a lot of industries are, uh, very rewarding, quite intense from time to time. It's very important to not lose context of the fact that there's more to life than, you know, the world of finance or the world of tech or whatever, the world of pharmaceuticals, right? It is a job. Uh, you shouldn't take it lightly. You should be excited. You should give it your all, but there's more to life than that, is another thing. So again, I try and keep that in mind. Easier
Well,
to say than do, but
yeah. Well, I love that. It sort of just ties in the entire concept of people ultimately, it's the main takeaway and the main, I think, keeping this job and any job running. It's very simple to sort of just take a step back and just look at how it's all people at the end of the day.
sure, yeah, absolutely.
Well, thank you very much. Really enjoyed speaking to you. It's been really insightful.
Likewise.
That's the end of our conversation, but thank you very much.
Have a good summer and then speak to you soon.
Thank you.